All right, I've got 3 after the hour. I just saw a couple of people hop in, so I think now is a good time to kick this off. Hello, everybody. Welcome to the WebEx event. We're going to be covering the FASB updates for revenue recognition. My name is Kyle Burdett, and I am the Marketing Manager for Financial and Intermediate Accounting at McGraw-Hill. Today joining us is the Executive Brand Manager for Financial and Intermediate Accounting at McGraw-Hill. Her name is Natalie King. And we also have a very talented author and presenter and professor, Mark Nelson, who's going to be leading us today as we discuss the updates for revenue recognition. So I just want to give you guys some tips as far as being a participant today. So I've muted everyone upon entrance, and that's just because we've got a lot of folks today that are attending, so we want to keep the chatter down to a minimum. But if you have a question or a comment, you can save it for the end. We're going to try to reserve a few minutes at the end of the session for a Q&A. But if you'd like to just make sure that I get your question, if you can scroll over to the middle of your screen right now, a drop-down menu should appear right in the top. And you'll see a bunch of different options, and one of them is chat. So if you click on that chat window, you can either send your chat message out to everyone, or if you just want me to take your question offline and have Mark follow up with you one-on-one, find me in the drop-down list and send me a direct message in the chat window. And that'll be an efficient way for us to not really interrupt the flow of the presentation, but still make sure that we get your question addressed. All right, some advice, if you could not place calls on hold. We've got everyone muted, but every now and again, placing a call on hold can send some weird feedback to everybody on the line. If you experience any glitches with the WebEx, shut down and log in again. Just know that we're going to be recording the WebEx, so we will provide access to what you're going to see here today after the fact. So if you miss a couple of minutes and you have to get back into the system, have no fear, you'll be able to catch what you missed. And finally, if you have any WebEx questions, if you're experiencing difficulties, the WebEx help number is 866-229-3239. All right, so now I want to tell you a little about our presenter today. So Mark Nelson has been kind enough to take an hour to explain the current updates for revenue recognition, but let me tell you a little about Mark. He's the Eleonora and George Landau Professor of Accounting at the Johnson Graduate School of Management at Cornell University. He's active on the American Accounting Association. He served 3 terms as an area editor of the Accounting Review, and he currently serves as a chair for the 2015 AAA Doctoral Consortium Committee. So Mark served a 4-year term on FASB's Financial Accounting Standards Advisory Council, and he frequently leads discussion groups at FASB's Financial Reporting Issues Conference. So his teaching focus is on intermediate accounting for undergraduates and for MBAs. He's won 8 teaching awards at Ohio State and Cornell, and he is pumped to be talking with everyone today about revenue recognition. So I'm equally as excited. Thanks for doing this, Mark. I'm going to turn it over to you.
Well, thank you, Kyle. It's rare that accounting professors are described as pumped, so that kind of made my day. It's great to have a chance to speak with folks today. Let me just follow up on one thing that Kyle said. If people have questions or comments or want to interact with me after the presentation, because I don't know how much time we'll have, we'll also give you my email, and you can certainly just contact me directly, because it's fun for me to get to talk to people about this stuff. Okay, so the topic of the day is ASU number 2014-09, revenue from contracts with customers. And as we all know, that was issued in May of 2014. It's this very comprehensive overhaul of revenue recognition standards. So it replaces Accounting Standard Codification 605 and approximately 200 items of industry-specific guidance. So it created ASC 606. It's also virtually converged with IFRS 15. So in the FASB and IASB's convergence agenda, This is, to my mind, the thing that's sort of the most tangible output of a very much converged standard. And that matters in a couple of ways that we'll be talking to. So in terms of this new ASU, one of the things that we're dealing with right now is figuring out when it's going to be required. The original effective date, when the standard was issued in May of 2014, was indicated to be for public companies for annual and interim periods starting after December 15, 2016. So in other words, basically for interim and annual 2017 periods. And under U.S. GAAP, there was no early adoption allowed. IFRS had basically the same effective date, but permitted early adoption. So that was the status quo. But then, perhaps not surprisingly, when this sort of sweeping standard got issued, there was a fair amount of pushback from folks in industry. Some saying we've been seeing this coming for a long time and we're prepared for the effective date as indicated, but others saying that they needed more time to adjust the systems to be able to handle the new standard, and also arguing that to be able to do a retrospective adoption where they restated prior comparative periods, they had to kind of know what revenue recognition under the new standard would look like for 2015 to be able to adopt it in 2017. So a fair amount of pushback on that adoption date. And so what the FASB recently proposed, and by recently I mean April 1, I believe it was, is a one-year delay on required adoption, but allowing early adoption according to the original effective date. So this is a compromise. And what it means is that some firms would be adopting it as anticipated in 2017, and others could wait until 2018. Also, there are likely to be some tweaks to the standard. So things that have been getting talked about are determining what constitutes a separate performance obligation, dealing with sales taxes, dealing with licenses. So there are some things that one could think of as just needing some additional definition or implementation guidance, but they might end up being in a slightly revised version of the ASU that eventually comes down the pipe. I think of these as tweaks. I think the basic ASU is going to stand as shown. So what's the current status? Well, FASB staff is preparing a proposal to delay. So this has to go through due process. They have to formally propose this. Then there's a 30-day comment period, and then there's a vote, and then we'll find out for sure whether this delay happens. My personal belief is that it's going to be as they're proposing, because they've had some time to think about this and to kind of work out this compromise. As for the IASB, they had originally indicated that they weren't going to delay. At least one member has come out and said that they might also delay the required adoption. Of course, IASB is already allowing people to early adopt. So we live in interesting times. So what does that mean for things we care about? Well, one thing is the CPA exam. And if you look at the AICPA's exam policy on new pronouncements, here's a quote. So accounting and auditing pronouncements are eligible to be tested on the Uniform CPA exam in the testing window beginning 6 months after a pronouncement's effective date, unless early application is permitted. That's my emphasis. When early application is permitted, the new pronouncement is eligible to be tested in the window beginning 6 months after issuance. In this case, both the old and new pronouncements may be tested until the old pronouncement is superseded. So we're in this weird world where it's issued, but we don't right now know the effective date. My personal belief is that ASU 1409 is going to be tested starting in mid-2017, because if FASB allows some companies to early adopt as of the start of 2017, that would be that 6 months after that early adoption date. But realize that IFRS 15 can be tested as early as January 1, 2016. And of course, IFRS gets on the exam also. And IFRS 15 is basically ASU 2014-09. So the short version is our students are going to be vulnerable to having this material tested on the CPA exam, I think, very soon. The other thing, though, is that the superseded gap, so stuff like the realization principle, the installment methods, and industry-specific areas, that is also likely to hang around and be tested on the CPA exam as late under these pronouncements as 2018. So again, we've got the ASU coming online, but the old gap not necessarily going away for a while. So what does this mean? Well, here's how we think about it. For our students, if we've got a junior taking intermediate accounting in the 2015-16 school year, okay, so next year, well, they'll graduate from a 4-year program in mid-2017. They'll graduate from a 5-year program in mid-2018. So it's likely that those students, I think it's certain to some extent at least, those students will face the ASU on the CPA exam, and it's definitely certain that they'll need to know this early in their professional careers because it is coming online. And so that means that we think it's something that we really need to focus on. So for us, of course, we write an intermediate accounting book as well as teach intermediate accounting. And this is the part of the talk that's a little bit of a commercial, but it also maybe helps you think about how we think about this topic. We feel like, our users' needs have to determine our coverage. And so we want to be very current and very comprehensive. We want to make sure that we're giving really full and rigorous coverage to the ASU. But we also have to be flexible because in interacting with the many people that use our book, they have different preferences. So we kind of divided people into 4 categories. One group want to focus on the ASU. They're saying, this is what's coming, so this is what I want to focus on in my teaching. Another are emphasizing the ASU, but they also cover some pre-existing gap because they think it's important, both because it's in place now, but also because sometimes it's an interesting comparison with what's going on with the ASU. Some are emphasizing pre-existing gap, but they also want to cover the basics of the ASU. And then some are saying, right now I just want to focus on the pre-existing gap that I've been focusing on, and I'll adopt, dealing with the ASU down the line. And so we want to kind of help everybody. I'm personally in sort of the second bullet point camp, gradually easing into the first bullet point gap. So there's still some aspects of pre-existing gap that I want to focus on for my students, but I'm emphasizing the ASU, and I'm going to be moving into completely focusing on the ASU because that's where my students are going to be. So how do we set this thing up? And this is going to help you understand how I'm going to attack the rest of this presentation, as well as how we think an intermediate book needs to prepare instructors to teach this ASU. So we start off with a part A of the chapter, for us chapter 5, that's this straightforward introduction to the 5-step revenue recognition process. And so this really gets into recognizing revenue first at a point in time, and then over a period of time, and then for a contract that has multiple performance obligations. It's interesting, when you actually read the ASU, of course it reads like a FASB standard, it's not easy reading, and it turns out that revenue recognition gets done at step 5 of this 5-step process, is when you're actually recognizing revenue. And if you write a chapter that way, students aren't recognizing revenue for a long time. They're doing all this setup stuff. So what we've done is to say, okay, let's really create this concrete foundation of saying, here's the basics of how this works. Here's how these 5 steps are applied for a point-in-time contract, a period-of-time contract, and then we combine those into a multiple deliverable arrangement that's really at the heart of the ASU. And so I'm going to walk through that part A to have people understand sort of how to get students set up on the basics of this approach. A lot of it's very familiar to existing revenue recognition requirements, but there's some interesting differences. And this is what, at least I think, sort of everybody ought to be showing their students at least this. Then what we have is Part B. And what Part B does is it builds on that foundation to cover key topics. So one really interesting key topic is estimating variable consideration. That's a pretty big departure from current GAAP, and I'm also going to be talking about that in this presentation because I actually think that is one of the most important changes in the ASU. But there are other important topics that we hit in Part B too. So estimating standalone selling prices that are used to allocate contract price to performance obligations, and then dealing with a whole bunch of different common contractual arrangements. So prepayments, warranties, franchises, right of return, bill and hold sales, consignments, seller payments to the customers, time value of money, principal agent. I mean, there's lots of different things that crop up. And how we've set up this section is to plug each of these into the key step of that 5-step framework, so that we're keep tying back to this sort of a conceptual framework that students can work off of, and also to make them self-contained enough that instructors can pick and choose. They don't have to cover all of this, but there are some that they may want to cover, and some might want to cover all. So that's kind of the setup. So then if you think about the rest of the chapter, there's two other parts in an appendix. There's Part C that's accounting for long-term contracts. And that's an interesting area. The debits and credits, frankly, haven't changed much. But when you qualify for percentage of completion versus completed contract, and what you call that's changed. And so we provide some in-depth coverage of long-term contracts. It's an important area, but frankly, that's an area that at least a few instructors I've talked to have said that they don't cover it. Most do, I think, but a few don't. So people don't have to. And then finally, Part D, profitability analysis, and this is a section that ties revenue recognition to really financial statement analysis and allows people to plug these concepts into thinking about, a DuPont decomposition and thinking about really some basic level financial statement analysis. And again, instructors can cover it or not as they choose. And then we've got an appendix, and what the appendix does is it provides coverage of the pre-SU gap that's going to be superseded by this ASU. So a lot of stuff is sort of modified under the ASU, but some things, like, for example, installment method, it just goes away. So we still have that. We've got a big table at the front of that appendix that shows the big things that have changed, and then that material's there for instructors who want it or want to refer students to it. And then finally, because there are likely to be some instructors that want to put off going to the ASU and instead want to focus on pre-existing gap entirely, we've created a version in this 8th edition of our book of the pre-existing gap revenue recognition chapter. So it's obviously updated, but it's still focusing on pre-existing gap and offering sort of where we're headed boxes and other stuff like that to talk about what's coming. And again, that's there for people who want it. It's available online. It can be downloaded as a PDF, and it's fully supported in Connect and with test bank and PowerPoint and instructor resource manual and study guide and all that stuff. We authors develop all that, and that's all in there. Okay, so the idea here is, different people are going to want to handle this transition in different ways. So we want to give you the pieces that you can use to be able to do that. And my commercial is about to end. And the rest of this talk, what I was going to do is I was going to walk through this Part A part, and then I was going to talk about estimating variable consideration under Part B. And those are, I think, to my mind, some of the juiciest topics relevant to the new ASU. So why don't I go ahead and jump into that? So thinking of Part A, thinking about these fundamentals, first off, obviously, let's nail down the core revenue recognition principle. Companies recognize revenue when goods or services are transferred to customers for the amount the company expects to be entitled to receive in exchange for those goods and services. So if we think about that definition, when is revenue recognized? Well, when we're transferring goods or services to customers. And in a second, we'll be talking about we're talking about transferring control. And then how much is recognized? Well, the amount the seller is entitled to receive is what determines the transaction price here. And that's really interesting because, as we'll talk about, the seller is entitled to receive variable consideration. So consideration that depends on the outcome of future events. And so we'll be estimating that and layering that into the contract price and recognizing revenue based on that contract price as we go, which is a pretty significant departure from current GAAP. Now, there's also a key constraint, and that is that no revenue is recognized unless it's probable that the seller will collect the amount it's entitled to receive under the contract. And that probability constraint is basically saying you don't have a contract if it's not probable that the seller is going to get paid. There has been some questioning by folks in practice about what this really means. What the FASB is saying is, they just want to make sure that they're dealing with substantive contracts here. But what it frankly means is that there are circumstances where this kind of a collectability criterion is going to exclude revenue recognition, at least early on. Interestingly, under IFRS, probable tends to mean 50% or more. Under U.S. GAAP, it's more likely or expected to occur. So the standards use the same word, probable, but they're thought to have different thresholds where there's a lower threshold to be counting as a contract under IFRS than under U.S. GAAP because of different interpretations of the word probable. So you can converge, but not if the words mean different things. Now, if you look at these definitions, it's kind of interesting to say, on the one hand, we don't have the realization principle here, right? We're not talking about the earnings process. But there's this critical role of delivery, of transferring goods and services. And there's still, because of this constraint, these concerns about collectability. So, sometimes I've talked to instructors who feel like everything they've ever sort of developed from an intuition standpoint with revenue recognition gets thrown out the window with this new standard, and I just don't think that's the case. There's this focus on, are you delivering something? Are you doing what you need to do, and are you going to get paid? That's still in here. Okay, so I've talked about these 5 steps. Let's kind of walk through them. First off, we identify a contract. So it's very contract driven. It can be implicit, it can be oral, but the contract is specifying legal rights of the seller and the customer. It's enforceable legally. And then we're identifying performance obligations. And this is a big deal in this standard. You can have a contract that has only a single performance obligation, so the seller only has to deliver one good or service, or it can have multiple performance obligations. And as we'll see, there's definition to be applied to figuring out whether we've got multiple performance obligations. Then we've got to determine the transaction price, regardless of whether it's single or multiple performance obligations. It's the same thing. It's the amount the seller is entitled to receive from the customer. We're going to allocate that transaction price. Of course, if there's a single performance obligation, we don't have to allocate it. But if it's a multiple performance obligation contract, we allocate the transaction price to each of the performance obligations based on their relative standalone selling prices. And I'll show you an example of that. And there, at that point, what we've really done is we've taken that multiple performance obligation contract and we've busted it apart. And so we've got each of these performance obligations that can kind of be thought of as standing on their own. And so when we're finally, in this process, when we're recognizing revenue, when or as each performance obligation is satisfied, well, for any given performance obligation, it might have revenue recognition at a point in time or over a period of time. And then for the multiple performance obligation contract, we'll just figure that out for each of these performance obligations separately. Okay, so some might be point in time, some might be period of time. And that's this 5-step framework. And so this is, what this is an illustration in our book, and then as I'll show you, we kind of build on this illustration. This is the framework that we'll use to keep giving students fence posts to kind of tie back to as they build their understanding of revenue recognition. Okay, so let's start off by thinking about recognizing revenue at a point in time. And so here, there's an indicator model, and the whole idea is, has control passed from the seller to the customer? And by that we mean, does the customer have direct influence over the use of the good or service, and has the customer obtained its benefit? So they've got it, or they can at least direct its use. And again, it's an indicator model. If you think about what the indicators are, the control has occurred, that has passed. For example, an obligation to pay the seller. Legal title to the asset is passed to the customer. The customer has physical possession. The customer has assumed the risks and rewards of ownership. The customer has accepted the asset. I mean, these are sort of SAB 101, 104 kinds of criteria. It sure looks like the customer's gotten the thing, and that's essentially what we're looking for here. So, as an example, we use this TrueTech company as a sort of a thread company throughout parts A and B, so we can have students working off the same company and thinking about different arrangements that company might have. In this case, TrueTech Industries sells the TriBox, a gaming console that allows users to play video games individually or in multiplayer environments over the internet. A TriBox is only a gaming module and includes no other goods or services, so it's basically an Xbox. When should TrueTech recognize revenue for the following sale of 1,000 TriBoxes to comp stores? So first off, December 20th, comp stores orders 1,000 TriBoxes at a price of $2.40 each, and they've promised payment within 30 days. Well, just under current GAAP, no entry because nobody's done anything yet, no deliveries occurred. But then on January 1, 2016, TrueTech delivers 1,000 TriBoxes and title passes, so guess what? Debit accounts receivable, credit sales revenue. That certainly looks familiar, doesn't it? I mean, it's just sale of a good like we're used to seeing. And then January 25, TrueTech receives $240,000 from comp stores, and so we get cash and we take down the receivable. So that's exactly like we're used to dealing with, sale of a product and transferring control at a point in time. It's really quite straightforward. Okay, what about revenue recognition over a period of time? So here the question is, do you qualify for revenue recognition over a period of time? And you qualify if one of three conditions holds. So first off, the customer consumes the benefit of the seller's work as that work is performed. And this is sort of your classic service, right? So a cleaning service. You're just, you're providing the service over time, so you can recognize revenue over time. Second, the customer is controlling the asset as it's created. So for example, you've got a building extension. And really one way to think about it is that the seller is providing the service of working on the buyer's asset. So once again, revenue recognition over time certainly seems appropriate. And then third, this was a little hairier, the seller is creating an asset that has no alternative use to the seller, and the seller has the legal right to receive payment for progress to date, even if the contract is canceled. So this is sort of your long-term customized contract kind of a provision. The example we had here was an order of jets customized for the U.S. airport. And you can imagine that in the process of developing the standard, this was something that people in long-term contract kind of circumstances, customized arrangements, wanted to have in there so that revenue recognition could occur over time. So the idea here is if any one of these three conditions hold, you qualify for revenue recognition over time. If not, it's point in time. And that's really how the ASU sets it up. So you ask yourself, do I qualify over time? If not, okay, point in time, and then the question is just when does control pass? Okay, so quick little example. Now let's say that TrueTech sells a 1-year subscription to the TriNet. It's a multi-user platform of internet-based games. And TrueTech sells 1,000 subscriptions for $60 each on January 1. Well, at time zero, they'll get the cash, but they won't recognize any revenue because they haven't provided the service of providing access to the TriNet. So we set it up as deferred revenue. A little terminology thing, because sort of the earnings process goes away in this standard. We don't so much talk in terms of unearned revenue. You'll find deferred revenue being the typical jargon that people use. But the same idea. We're setting it up as a liability. And then, over the next 12 months, each month, we'll recognize 1/12 of a month of revenue and take down that deferred revenue by 12. So we'll just chip away at the 60 and take it down to 0 over the 12 months. And we'll build up revenue over the 12 months. And again, this is exactly what we're used to seeing. It's just a slightly different process of qualifying for revenue recognition over a period of time. In terms of estimating progress towards completion, once again, it's pretty straightforward. With our TriNet service contract, it makes sense to use an output-based, where just passage of time, where we're giving people access to the TriNet, perfectly good way to figure out how done we are, but input-based estimates are also allowed as in current GAAP. Okay, so now, what about multiple performance obligations? And I don't know what your experience has been like, but for me, that's proven to be a little bit more complicated thing to teach to students. And and it's at the absolute heart of this standard. I mean, one of the reasons why the standard is set up the way it is that so many arrangements have multiple performance obligations in them, and it's trying to grapple with that in a consistent way across industries. So here the idea is if we're dealing with the potential for multiple performance obligations, a couple of these steps in the 5-step framework are more important. So, we've identified a contract. Well, we've got to identify the separate, distinct, as we'll talk about, performance obligations in the contract. And then after we determine the transaction price, we've got to allocate that price to each of the performance obligations. And then we'll recognize revenue for each at the appropriate time. The easiest way to think about this is with an example. And so to help our students sort of build their understanding, what we do is simply create a multiple performance obligation contract which combines the two contracts that we just talked about. So now we've got TrueTech manufacturing the TriBox system. And the TriBox system includes the physical TriBox module as well as a 1-year subscription to the TriNet multi-user platform. So we just smushed together the other two contracts we've talked about. And as before, the TrueTech TriNet platform subscription sells for $60, and the individual TriBox sells for $240, but as a package deal, it sells for $250. And on January 1, TrueTech delivers 1,000 of these TriBox systems at a price of $250, and they get paid on January 25th. So let's just assume we've got a contract here. And let's go through the process of deciding whether we have separate performance obligations. So you're presented with this system and said, well, does the system have one performance obligations or two? And the key jargon here is that the good or service needs to be distinct for the performance obligation associated with delivering that good or service to be treated as a separate performance obligation. And so what does distinct mean? Well, two things have to hold. It has to be capable of being distinct. And there the idea is that it just sensibly has to be something you could sell on its own and that could be usable by a user either by itself or in combination with something else, right? So the idea is this something that it makes sense for a consumer to buy by itself. And then it has to be separately identifiable from other goods or services, or sometimes this is described as distinct in the context of the contract. And here the idea is that it's not so interrelated with the other parts of the contract that it just doesn't make sense to think about it as a standalone thing. That really what the seller is doing is providing the service of interrelating these things and having them depend on each other. So, the classic example of failing this criterion is a long-term construction contract, where you can have nails and wood and glass and steel, and all of those things are capable of being distinct. But what the seller is doing is not only delivering those things, but providing the service of interrelating them. So it just doesn't make sense to have a gazillion little contracts for each of those pieces. You've got one deliverable providing that construction, that final output. And so that's treated as a single performance obligation. Okay, well, thinking about our TriBox system, that's got two distinct goods and services because both the module and the subscription can and are sold separately and can be used with other stuff. They're not super interrelated. So we'd say, okay, we've got two performance obligations that we have to deal with in this arrangement. Okay, so we got these two performance obligations. Step 3, what's our transaction price? And it turns out that that's pretty easy here. $250 a system times 1,000 systems takes us to $250,000. So that's not too bad. So, okay, well now, step 4, we got to allocate that transaction price. And so for each system of 250, we're going to have to allocate a chunk of that to each of our two performance obligations, the TriBox module and the TriNet subscription. And we do that based on relative standalone selling prices. So we know that the TriBox module sells individually for $240 and the TriNet subscription for $60. So we'll give 240 divided by 300, 240 plus 60, or 80% of the transaction price to the TriBox module. So it gets 200 of the 250. And the TriNet subscription, of course, that gets the rest, 60 300s or 20%. And so we'll take that 250 transaction price, and really we're busting the contract apart. We've got a $200 module and a $50 subscription in terms of how we're going to be accounting for this thing. Okay, so then we're going to recognize revenue when or as each performance obligation is satisfied, step 5. And so on January 1, TrueTech records the revenue from the TriBox modules, but defers revenue for the TriNet subscription. So you can see they're debiting AR for the $250,000 they're owed for the systems. They're booking sales revenue for $250,000 times 80%, so that's the $200,000 associated with the TriBox modules. And then they're setting up deferred revenue, not for $60,000 as we did for the standalone TriNet subscription contract, but for $50,000 because that's the chunk that's been allocated to it. And then going forward, in each of the 12 months following the sale, they're going to take down that deferred revenue for 1 month's worth, or $50,000 divided by 12, 4167, and book service revenue for that amount. So, it's the same subscription. We're recognizing revenue differently. Why? Because as a basket, the system had a discount on it. It wasn't sold for $300, it was sold for $250, and that's spread across the 2 performance obligations. But you can see that structurally it's the same place. And I found this a very easy way to help students see how a point in time, a overtime, and a multiple deliverable contract get treated. They kind of nod along with you and are pretty comfortable with it. So if we want to sort of think about where we've been, here's what we have in the chapter are these tables that students really seem to like in terms of a study aid. So we've built the idea of identifying a contract. We've identified, defined what it means for performance obligations to be distinct. And then after computing the transaction price, we've shown how that allocation happens across multiple performance obligations based on standalone selling prices. And then we've recognized revenue at a point in time according to indicators of whether control is passed, or over a period of time if we qualify for period of time recognition according to the 3 criteria that we've talked about. So that's really part A. And the idea here is that it's a grounding, sort of a foundation of understanding the 5-step framework with simple contracts, but ones that combine to help you think about a multiple deliverable arrangement. So part B has lots of I think, really interesting stuff in it. And when you work long enough on this revenue recognition stuff, you really get excited about it. So there's a lot of stuff in Part B that is really pretty interesting. So step 1 is thinking about the specific requirements for a contract to exist. Step 2 is thinking about different kinds of performance obligations and whether they meet this criterion of being distinct or not. So prepayments, warranties, both quality assurance and extended warranties, customer options that do or don't provide a material right, thinking about those and whether they need to be treated as separate performance obligations. That's something pretty different from how a lot of us have taught revenue recognition before, which is a big part of the ASU. Step 3, thinking about the computation of transaction price, and here's where I'll get into these variable consideration arrangements. And related to the transaction price topic, thinking about right of return as a form of variable consideration, thinking about principal versus agent issues, time value of money, so imputing interest revenue or interest expense as part of the contract, payments by the seller to the customer. All of those figure into this idea of coming up with what the transaction price is. Step 4, various approaches to estimating standalone selling prices. Companies can use an adjusted market assessment approach, an expected cost plus margin approach, a residual approach. So those are all available and important things to cover. And then step 5, talking about aspects of revenue recognition arrangements that can be challenging or at least complex. So licenses, franchises, bill and hold arrangements, consignment arrangements, gift cards. And here, a lot of it is just sort of saying, do we have a point in time versus a period of time thing? Or do we have a situation where it's just particularly tricky to figure out whether control is passed to the customer? And so that's something that we need to deal with in detail. And then there's, we don't go in a huge amount of detail, but certainly this is a standard that's requiring companies to provide a lot more disclosure about revenue recognition than we've seen previously. It's always been kind of funny, right? I mean, you'll have pages and pages and pages of pension notes, but then for revenue recognition, you'll have a little paragraph sitting in the accounting policies area of the note 1 of the financial statements. Well, that's changing. There's going to be a lot more interesting information with respect to revenue. Okay, so let's talk about this idea of variable consideration. And so here what we're talking about is some part of the transaction price that depends on the outcome of some future event. So there's a contingent consideration part of this thing. And we know there are examples of this across the board, right? So entertainment and media, there are royalties. Healthcare, well, reimbursements from Medicare and Medicaid. Manufacturing, volume discounts, product returns. Construction, being concerned about incentive payments, telecommunications, rebates, I mean, the list goes on and on. And the way we handle this in current GAAP is somewhat inconsistent, but with most circumstances where we've got a chunk of the contract where the amount that we get paid depends on the outcome of some future event, we're often waiting until that uncertainty resolves before we'll allow someone to accrue revenue associated with it. It's sort of a flavor of conservatism that's buried in there. We don't want people to be accruing revenue when there's significant uncertainty associated with it. And this ASU does not take that approach. So what this ASU says is, hey, we've got some uncertainty associated with this transaction price because some of it is going to be received in the future, depends on the outcome of a future event, but let's go ahead and estimate that and layer that into the transaction price at time 0 and then go ahead and recognize revenue based on that transaction price that includes that estimate of variable consideration. Now, in terms of the estimation process, the standard allows an expected value approach or a most likely amount approach. So in thinking about how that would apply, let's just do another example. So back to TrueTech. Now, TrueTech is entering into a contract with ProSport Gaming to add ProSport's online games to the TriNet network. So ProSport offers popular games like Brawl of Bands and wants those games offered on the TriNet so ProSport can sell gems and weapons and health potions and other game features that allow players to advance more quickly in a game. And if you don't think that's a viable business model, you haven't heard of the companies doing Clash of Clans and other kinds of games. It's a very lucrative business model. So ProSport is basically using the TriNet as a conduit to get to buyers of this stuff. The terms of the contract are on January 1, 2016, ProSport pays TrueTech an upfront fixed fee of $300,000 for 6 months of featured access. And then ProSport also is going to pay TrueTech a bonus of $180,000 if TriNet users access the ProSport games for at least 15,000 hours during the 6-month period. Right, so the idea is the contract has 2 parts. ProSport pays $300,000 up front, and then if we reach this threshold to get the bonus, they'll pay an additional $180,000. And so the $180,000 is the variable consideration component of the contract. And TrueTech estimates a 75% chance that it will achieve that usage target and receive the $180,000 bonus. So you can see right away there's obviously a pretty judgmental component to dealing with this variable consideration. Okay, well, at inception, TrueTech's going to get that $300,000 fixed fee, and they're going to recognize revenue over time associated with that amount because they're providing the service of letting ProSport feature its games on the TriNet. So they defer that revenue. And then they're going to have to figure out what their contract price is at time 0 for purposes of starting to recognize revenue over time. So one possibility is an expected value approach. So they could say, well, one possible outcome here is that we get the $180,000 bonus. And so that plus the $300 fixed fee takes us to one possible outcome being $480,000 for the contract. 75% chance of that gives us a $360,000 expected value just for that component. But you know what? Another outcome is that we don't meet the threshold, and so we get 0 bonus. So we have an outcome of $300,000, 25% chance of achieving that. So the total expected value of the contract would be $360,000 plus $75,000, or $435,000. And what TrueTech would say is our estimated contract price at time zero is $435,000, and that's what we're going to base our revenue recognition on going forward. So that's an expected value approach. A simpler approach is a more most likely amount approach, where TrueTech says, you know what, I got a 75% chance of getting the bonus, so I'm going to say that my contract price is $480,000. And then what they're going to do at time zero is still book the $300,000, but then over time, each month, recognize revenue based on that $480,000. So they'll say $480,000 divided by 6 takes me to $80,000 of service revenue I'll recognize each month. And then what am I going to do? Well, I'll recognize $50,000 of deferred revenue of that initial $300,000 that I set up, but I will accrue a bonus receivable of $30,000. So each month, month in, month out, they're recognizing $80,000 of revenue, and they are gradually building up this bonus receivable under the assumption that they meet that threshold. Now, let's say that TrueTech receives that bonus, so they meet the threshold. Well, they're going to take down the bonus receivable by $180 at the end of the 6 months, and they'll get the cash coming in the door. They don't recognize any revenue at that point because, right, they've been recognizing it for the last 6 months under the assumption that they're going to meet it. Now, what if just right at the end of the contract they only reach a usage level of, 14,990 hours? They don't make 15,000, so they don't get the bonus. Well, they still take down the bonus receivable, but now their debit is not to cash, it's to service revenue. And they have this big downward adjustment to revenue as they true up their estimated contract price. And this is the thing that's potentially concerning about this whole variable consideration approach, is the potential for optimistic estimation, pumping up revenue early on, and then end game corrections. So what if actually you're revising your estimates as you go? You don't have a big surprise happen right at the end, but rather early on or partway through, as you're monitoring usage, you say, you know what, after 3 months, TrueTech concludes that due to low usage of pro sports games, the most likely outcome is that it's not going to get the 180. Well, they've been accruing revenue as they've gone. For the first 3 months, they've built a bonus receivable, 30, 30, 30, so they have 90 in bonus receivable, and you can see in the T account to the right, they've been recognizing revenue, 80, 80, 80 for those first 3 months. So now after 3 months, what do they have to do? They correct their estimate. So they take down the bonus receivable, they have an adjustment to service revenue, and it's the same structure of the journal entry we saw on the prior slide, it's just for 90 rather than 180. And then for the last 3 months, they're going to go ahead and simply be debiting deferred revenue and crediting service revenue for the $50,000 of the fixed component of the contract, and no longer be recognizing any revenue associated with the variable component because they don't think they're going to get it. So that would be sort of revising estimates as we go. And you can imagine that firms that have these sorts of variable consideration arrangements are a little concerned that they may have to be changing their revision of estimates fairly frequently. Now, here's an interesting criterion designed to mitigate the worry that I was expressing. There's a constraint. Sellers only include an estimate of variable consideration in the transaction price to the extent that it's probable that a significant revenue reversal will not occur when the uncertainty is resolved. So what this is getting at really is, how good is the seller's estimate of variable consideration? And if they don't think that it's good enough, then if they book some revenue based on variable consideration and later find out they're wrong, they have to reserve that. They have to reverse that. So the idea here is that you only get to book this variable consideration if you think it's probable that the significant revenue reversal won't happen. And interesting, in IFRS 15, this is highly probable rather than probable. So everybody wants it to be, the sort of the relatively high probability level that we assume in U.S. GAAP. It's an indicator model to figure out whether or not that probability criterion is satisfied. So the idea is, hey, maybe you aren't making particularly good estimates if you have poor or limited evidence on which to base an estimate, if your estimate depends on factors outside the seller's control, if there's a history of the seller changing payment terms, so you really can't rely on the terms that are specified. There's a broad range of outcomes, so it's just particularly unclear what's going to happen. A long delay before uncertainty resolves, again, making it less clear. So those indicators could drive a seller to think that it's not probable that a significant revenue reversal will not occur. And therefore not recognize the variable consideration component. So how would that work? Let's say that starting off in this contract, TrueTech initially concludes that it's not probable that a significant revenue reversal will not occur. And I hate the double negatives, but it's kind of how these things are written. Well, in that case, they say the constraint applies. So each month, they're just going to recognize the $50,000 of revenue associated with the fixed payment. And then let's say that after 3 months, TrueTech has enough information to say that, we actually think that we're going to be able to make an accurate enough estimate for it to be probable that a significant reversal won't occur. And they estimate that the bonus as the most likely amount has a 75% chance of happening. So they go ahead now and make an adjustment at the start of their 4th month to true things up to where it ought to be, to say, okay, well, if only we'd known that all along, we would have been accruing a bonus receivable and booking service revenue at $30,000 a month in addition to the 50 we've been recognizing. So let's true us up to where we need to be, debiting bonus receivable and crediting service revenue for that $90,000. And then in the other remaining 3 months, we'll go ahead and take down deferred revenue, set up bonus receivable, and recognize service revenue at $80,000 as we go. So, these different sort of permutations really highlight that the way this is set up is you set up your estimate, however you're going to do it, most likely amount or expected value, and then you true that estimate up as information changes. And included in that would be if you believe the constraint applies, so you don't recognize revenue associated with variable consideration early on, but then later on you believe you can, well, once again, you true up your estimate and get yourself to where you need to be from a bonus receivable and service revenue standpoint, and then go on under your new set of estimated facts as you go. So I just think this is a really interesting aspect of the standard. It's bringing a lot of judgment in. It is, obviously there's some potentials for abuse here. It's something that gets the students revved up. They're very interested in, talking about it. Okay, so I'm about to show you a slide that might be scary, but don't let it scare you. This is the slide that captures what we've built in Part B. And I just wanted to show it to you because it's another one of these summary slides, summary tables that we've got in the chapter that builds on the framework. So, step 1, for example, the far right column, we're talking about the circumstances that determine whether a contract exists and circumstances in which a contract doesn't exist. Step 2, we talk about performance obligations, and far right column, we talk about how quality assurance and warranties and customer prepayments don't qualify as performance obligations. Extended warranties and options that provide a material right do qualify as performance obligations. Step 3, determining the transaction price. We talk about variable consideration and the constraint. We talk about principal agent concerns, financing components of contracts, seller payments. Step 4, allocating transaction price. Here we talk about the approaches to estimating a standalone selling price. So adjusted market assessment and cost plus margin and residual approach. And then step 5, talking about recognizing revenue when or as a performance obligation is satisfied. Here we walk through all of these different arrangements that are just a little bit more complicated and sort of deserves the special mention. So licenses. This is an area that, frankly, the standard setters are continuing to struggle with. When should you recognize revenue at a point in time when the license is transferred to the customer versus a period of time because the idea is that the seller is providing some ongoing service associated with that license. Franchises. Here's a situation where we may have a license involved, but we've also got some point in time and period of time kinds of revenue recognition arrangements. Bill and hold, consignment, well, when does control pass? Gift cards, really highlighting the idea that these are deferred revenue circumstances, but also dealing with gift card breakage. So these are all different arrangements that we set up and that instructors can cover to the extent that they want to cover. Now the final thing I just wanted to mention is in the appendix, we have an illustration where we just compare previous GAAP and new GAAP and talk about the big differerences, and then walk through the previous GAAP and help people cover that to the extent that they want. So just looking down the the leftmost column. So we highlight differences in the key concept underlying revenue recognition, the role of collectability in determining whether revenue is recognized, criteria for recognizing revenue over time, accounting for multiple performance obligations, treatment of customer options for additional goods and services, treatment of variable consideration, and treatment of time value of money. All of these are things that differ some under the old and new GAAP, and we wanted to give a convenient kind of summary for that before going into the old GAAP. All right, well, that's what I had for our hour-long time together. I think I've kind of come up right against it, but I'm also happy to entertain some questions now. Alternatively, again, here's my email, mwn2@cornell.edu. I'm more than happy to correspond with anybody who's interested in following up more about this. I think this ASU is really interesting. It's a real opportunity for intermediate accounting instructors. I know it's a hassle to get up to speed on something new, but this is really interesting and I think economically rich and practically rich material that I've found really turns students on. So it's a neat thing for us to be able to cover in our courses, and I hope you find this a useful way to help you into that transition. At this point, Kyle, why don't I turn it back to you?
Sure. All right, so we've got less than a minute until we're up against the hour. I've been scanning the chat, and I received a couple of one-off requests, but by and large, don't have too many questions. So I'll just follow up with you offline, Mark, and we can handle those questions in a one-on-one manner.
That's fine. And again, people, please feel free to contact me. I know I filled up the hour, and sorry, but I wanted to give you as much content as I could. And again, I hope you found it useful.
All right, here's one question on the way out the door that I think maybe we could clear up. Do you have time for one? All right, it says, can you please reiterate the difference between unearned and deferred revenue and why the change to the terminology?
Yeah, I think that the difference is purely terminology. And frankly, what the story is that some of the kind of the discussion around this new ASU is to get away from the earnings process and to say, we're not going to focus on whether revenue has been earned. Rather, we're going to focus on whether or not a performance obligation has been satisfied. And so it's kind of interesting. This ASU, when you're reading it, words like earn, get into Part A of the ASU and search earn, and you don't find it much. Similarly, percentage of completion method is gone. Now, we can recognize revenue over time according to percent complete, but that's not the percentage of completion method. So it's terminology. But I think in this case, what it signals is saying, yeah, you can defer revenue, but we're not thinking about the earnings process, and therefore we're not going to talk about whether or not something's been earned or whether it's unearned. That's the basic story.
Awesome. Okay, so we're a minute over now. We're going to just take the rest of the questions offline. I just wanted to, that one came in right at the buzzer there, so it caught my eye. Thanks everyone for attending. We're going to be posting this online so that if you'd like to revisit any of the topics that were discussed today, you'll be able to do so at your leisure. But really appreciate your attendance, and please follow up with me, Kyle.Burdett at mheducation.com, or Mark, he's nwn2 at cornell.edu. I really appreciate your attendance, everyone. Thanks, Mark.
Thank you. Thanks all.